Hey everyone, welcome back to the channel. Dividend investing is all about choosing the right companies to build a reliable and growing income stream. I'm going to walk you through 5 simple steps to analyze a dividend stock like a pro. Whether you're new to investing or looking to refine your strategy, this guide will give you actionable tools to evaluate dividend-paying companies. Let's dive in. The first step in analyzing a dividend stock is checking the dividend yield. This metric tells you how much cash flow you're getting for each dollar invested in an equity position. It's a crucial indicator of the income-generating potential of your investment. It's super easy to calculate. You just divide the annual dividend by the current stock price. For instance, if a company pays an annual dividend of $4 and its current stock price is $100, the dividend yield would be 4%. This simple formula helps you quickly assess the return on your investment. For example, a stock trading at $100 per share with a $4 annual dividend has a 4% yield. This means for every $100 you invest, you receive $4 annually. However, it's important to understand that a high yield isn't always a good thing. While a higher yield might seem better, be cautious of yields above 8 to 10% as they can signal trouble. High yields can sometimes indicate that a company is in financial distress or that its stock price has significantly dropped. Always investigate the reasons behind an unusually high yield. Instead, focus on stocks with yields between 2% and 6% for a balance of income and sustainability. This range is generally considered healthy and sustainable, providing a good mix of income without taking on excessive risk. Companies with yields in this range are often more stable and reliable. Remember, the dividend yield is just one piece of the puzzle. It's essential to look at other factors such as the company's financial health, growth prospects, and overall market conditions. A comprehensive analysis will help you make more informed investment decisions. Let's move on to the next step. In the next section, we'll explore how to evaluate the company's financial health to ensure that the dividend is sustainable. Next up is the payout ratio, which tells you what percentage of a company's earnings are used to pay dividends. This ratio is crucial for investors as it provides insight into how much money a company is returning to its shareholders versus how much it is keeping to reinvest in the business. Calculate it by dividing the annual dividend per share by the company's earnings per share. This simple formula can reveal a lot about a company's financial health and its priorities. For example, a company earning $5 per share with a $4 dividend has an 80% payout ratio. This means 80% of its earnings are paid out as dividends, leaving only 20% for other uses. A high payout ratio might seem great but could indicate the company lacks funds for growth or to weather downturns. If a company is paying out most of its earnings, it may not have enough left to invest in new projects or to save for tough times. Ideally, look for companies with a payout ratio below 60%, especially in growth industries. These companies are likely reinvesting a significant portion of their earnings back into the business to fuel future growth. Companies in stable industries like utilities might have higher ratios due to predictable cash flows. These companies often have less need for reinvestment and can afford to return more money to shareholders. A lower payout ratio is usually a good sign. It indicates that the company is retaining more of its earnings, which can be used for growth, debt reduction, or other strategic initiatives. Always consider the industry context and the company's overall strategy when evaluating the payout ratio. Step 3 is to examine the company's dividend history. Has the company consistently paid and increased dividends over the years? Companies with a long track record of dividend increases show commitment to rewarding shareholders. Look for dividend aristocrats, companies that have increased dividends for at least 25 consecutive years. Avoid companies with a history of dividend cuts, as they signal instability. Consistency and growth in dividend history are key indicators of a company's commitment to shareholders. Now let's talk about a company's financial health. Understanding a company's financial health is crucial for making informed investment decisions. It involves analyzing various financial statements and metrics to gauge the company's stability and growth potential. A dividend is only as strong as the company paying it. Dividends are a portion of a company's earnings distributed to shareholders, and they can be a reliable source of income. However, the sustainability of these dividends depends on the company's overall financial health. Key metrics to look at include earnings growth, debt levels, and cash flow. These metrics provide insights into the company's profitability, financial obligations, and liquidity. By examining these factors, investors can make more informed decisions. Earnings growth indicates profitability and potential for future dividend increases. Consistent earnings growth suggests that the company is expanding and has the potential to increase its dividend payouts over time, benefiting long-term investors. Too much debt can be a red flag. Check the debt-to-equity ratio for a sense of risk. A high debt-to-equity ratio indicates that the company is heavily reliant on borrowed money, which can be risky if the company faces financial difficulties. Cash flow is crucial. Ensure the company generates enough to cover dividends and other expenses. Positive cash flow indicates that the company has enough liquidity to meet its financial obligations and invest in growth opportunities. Analyzing financial health gives a clearer picture of a company's ability to sustain dividends. By thoroughly examining these financial metrics, investors can better understand the company's long-term viability and make more informed investment choices. The final step is understanding the industry and risks associated with the company. Consider the broader economic landscape and specific industry challenges. For example, the oil and gas industry is cyclical and influenced by global factors. Retail faces disruption from e-commerce giants like Amazon. Different industries face different risks and opportunities. Understanding these helps assess the sustainability of a company's dividend. Read industry reports, follow news sources, and monitor competitors to stay informed. To recap, here are the 5 steps to analyze a dividend stock like a pro one. Check the dividend yield. 2. Review the payout ratio. 3. Examine the dividend history. 4. Analyze the company's financial health. 5. Understand the industry and risks. Thanks for watching. If you found this video helpful, like, subscribe, and hit the notification bell. Share your favorite dividend stock in the comments below. Until next time, happy investing.